All right, I'm Michael Hartzman on tonight with my guest host and guest in general, John Eade, President of Argus Research and Director of Portfolio Strategies. Good evening, John. How are you? Welcome to the Lebenthal Report.
Thank you, Michael. I'm terrific, and I'm glad to be on with you tonight.
Thank you. With Dom out of the country and unavailable, we enlisted you to do double duty. We appreciate that, and we haven't had you on in a while. Uh, Lots have been going on. What I normally do with Dom, as you know, is just go over the numbers from last week real quick. So let me start there, and then we'll jump off from that point. So last week, John, we had a lot of mixed data, and the S&P 500 and other markets kind of reflected some of the uncertainty. The S&P was down about 2.3. The Dow was down almost 3%, 2.92. And the Nasdaq actually held up relatively well compared to the other two, down 2.16. All the indexes are still up for the year, which is still a little surprising to me in and of itself. And you know what, John, with all the mixed signals and all the headlines throughout the year, to me, last week was just another week in the summertime. I mean, what was your takeaway from the mixed bag of news we had last week?
So, Michael, I think that's a good point. In some ways, it seems like an upside down year, right? We started off the year at Argus thinking that the bull market would continue in 2025. And so far it is. It was close there, in April. We almost lost that bull market, but we've recovered. But the idea was that, the economy is going to continue to grow here in the US. Interest rates will be declining throughout the year, and earnings growth would be good at a double-digit pace. And those three factors would combine to lift stocks. So that's kind of what happened, but not exactly according to that script, right? I mean, to your point, I guess it was last week we got the first reading on second quarter GDP, and that was up 3%. That's a wonderful number, but it's a huge turnaround from a decline that we saw in the first quarter of negative 0.5%. So, maybe the economy's averaging around 2% growth, which is kind of that long-term number. Um, but those numbers were affected by a couple of real wild cards. You know, Imports are part of GDP, and imports um, take away from GDP when they increase. So there was a whole bunch of imports in the first quarter. That's why we were negative. But then there were no imports in the second quarter. So that's why we were positive. So,
Hmm.
um, the numbers themselves look good, but what's behind those numbers, I think kind of gets to your point. Like it's a little bit different this year.
So let's talk about that second quarter in particular. I mean, if I would have asked you to make a bet the third week in April when we were in that teeth of that sell-off and tariff turmoil, if I said to you there's nothing to worry about, GDP was going to come in at 3%, would you have felt that was a little bit that my glass being half full? Would that have appeared too optimistic at that point?
I don't think so, Michael, and that's because we saw something very similar coming out of the pandemic.
Mm-hmm.
The short rule of thumb for Wall Street has been two negative GDP quarters in a row equals a recession. No
Mm-hmm.
questions asked. That's what you
Mm-hmm.
get. However, we did have two negative quarters. I think it was in 2022, but nobody ever called a recession. And the reason that the economic bigwigs down in DC didn't call a recession was because the employment situation has been so robust. We have unemployment at 4.1, 4.2%. That is very near all-time lows, right? We're essentially at full employment. So anybody who wants a job has a job, almost. Um, And and when you're thinking about a recession, you're thinking about unemployment of maybe 8% or 10%, and people can't get jobs.
Hmm.
So back in April, to answer your question, sorry for such a roundabout way, but back in April, the unemployment rate was, still low, right around 4%. So I kind of thought that we would avoid a recession because the consumer sector and the employment environment has been so strong, really these past few years.
But again, I get that, and I agree with you. But weren't you concerned, or was August concerned about the deconstruction of the economy from the point of view, especially small business owners? They were, again, I know small business owners in particular who basically stopped building their inventories because they didn't know what things were going to cost. And they thought if they waited it out, the tariffs would be resolved and the price of things would go down. So I was concerned that if the small business owner isn't building up their inventories, or the consumer itself is not willing to pay for these increased prices if they felt it was going to be temporary, that would have stalled the economy. But obviously, it didn't. The economy continued to just kind of chug along.
It's chugging along, but there are, spots that raise a little bit of concern. One, I think, would be home building.
Hmm.
Homes just aren't selling as fast as they were over the past couple of years. And interest rates are high and inventory is low and people aren't really wanting to move and builders aren't incentivized to build. So I think you're starting to see maybe some cracks in the economy. But then you look at, a big part of the economy like consumer services, and those are still going. People are still going out to restaurants, they're still going on holidays. So I think there's enough there, Michael. I'm not going to say we're going to grow 4% GDP, right? We're not India, we're not China, but I do think we will avoid that recession, and I do think the economy can grow at a 1 plus or almost 2% rate here in the second half of the year.
Do you also believe in the narrative, John, that we're a service economy? That we don't really make a lot of stuff. We import a lot of stuff, but we're basically a service economy. Therefore, we were able to not avoid, it's the wrong word, we're able to absorb these tariffs a little bit more easily than originally anticipated.
Um, I think so. Um, we're definitely a service economy, but I would say that we have a few um, core competencies in our country. And Michael, we try to invest around those core
Hmm.
competencies, right?
Hmm.
We're really darn good at technology innovations.
Hmm.
You look at our tech sector and you try to find one in Japan, it's not there. In Europe, it's not there. China may be close, but no one really knows. We're very good at technology. We're very good at allocating capital, Michael. Companies come to the New York Stock Exchange to raise money from investors because we have smart investors who think hard about what they want to invest in, and they're willing to make those investments. So the banks and the brokers, is another area that we like to invest in. We're really good, Michael, kind of sadly, at designing weapons,
Hmm.
aerospace and defense. Wow, we've got some, great jets coming out of Lockheed Martin and Northrop Grumman. That's not quite the same kind of growth industry necessarily that like semiconductors or technology is, but it's pretty much recession proof, certainly with the way things are going in the world right now. And these defense companies pay pretty good dividends too. So it's a nice kind of anchor in a portfolio. And a fourth area that I would think about too would be discovering innovative new drugs and treatments for healthcare conditions. Our healthcare network, not network, but the pharmaceutical companies and biotech companies, again, are world leaders in developing, cures or progressing toward cures for these conditions. So yes, we do a lot of services, and I think the supply chain is another strength of our economy, the trucks, the rails, um, but those four core competencies, the healthcare, biotech and pharma, the aerospace and defense, the raising cap and allocating capital, and technology developments are really some of the themes that we've been trying to focus on when the kind of noise has been loud outside of the normal economic data.
Seems like the noise is always loud, John. It just seems it's a little louder now. And what I want to do, and that was a great explanation, by the way, of our economy. But what I want to spend a few minutes on, if I can, is impose upon you to put your professor hat on. And let's do a little economics 101. You know, the regular investor comes home, puts on the news, and sees Donald Trump and Jerome Powell, in a construction site with hard hats arguing over the remodeling of the Federal Reserve. And it all comes back to interest rates. So if you can spend a minute in trying to explain to our listeners and viewers why the Fed is supposed to be independent and what their mandate actually is, and why it appears that Jerome Powell seems to be ignoring the president to the best of his ability.
Okay.
I
Um,
know it's a lot.
yeah. Well, going back to one of those core competency concepts and the raising and the allocating capital,
Hmm.
one of the bedrock principles behind that is the independence and the transparency of our financial system, right? We have quarterly earnings reporting periods. Not many other countries in the world, have those kinds of uh, communications between companies that are being invested in and investors. When companies raise money in the SEC, they have to file hundreds of pages of documents. They have to jump through many different hoops in order to qualify to be listed as a company on the New York Stock Exchange or the NASDAQ. So there's a lot of infrastructure and independence in there put in place on behalf of investors who are always going to want to look for the freshest data, the most accurate data, and you know they're also looking for data that is not influenced by politicians per se, but by what's actually going on in the U.S. and the global economies. And that's where we start to get to President Trump and Jerome Powell. Trump, of course, appointed Powell to be the Federal Reserve chair. The chair before Powell was a woman named Janet Yellen, who was pretty darn good. And I thought Trump liked her. And I thought, it might be an olive branch that Trump could offer to Wall Street. Like, hey, I'm not going to boot Janet Yellen. She's done a good job. She's bipartisan. We're going to run with her. No, he didn't. He booted her and he brought in Powell, who's
Well,
been good.
Janet Yellen wasn't tall enough, I heard.
Yeah, right. Um, I think Powell has done a good job. It fell behind the inflation curve. They got back out in front of it. Rebounded from the pandemic quickly. Bull market, still intact. Going back to 2022, um, lifted interest rates aggressively, wrestled CPI inflation back toward 2%. Never quite got it there. Maybe it got down to 2.3, 2.4. It's back up, probably closer to 3% now. And so he's holding off a little bit. everybody, the Fed governors think they're planning on reducing rates later this year, but later this year just isn't fast enough for President Trump. Now he's backed away from outright firing Powell, like Billy Martin used to get fired in the
Hmm.
middle of the season by George Steinbrenner. Um, so that threat seems to be removed, but he's keeping Powell on the hot seat with his comments and decisions that he's making on other economic data points as well.
So to your point, Jerome Powell's mandate, the Federal Reserve's mandate, job one is to fight inflation. Job two is job creation, and job three is avoid a recession. I guess in no particular order.
Well, no, it's that they have what they call a dual mandate.
Uh-huh.
So job one is to keep inflation at 2% uh, over time. That means if it's like 2.5% for a few months and it's 1.5% for a few months, it averages 2%. It doesn't have to just sit at 2%.
Hmm.
And that is a number that they've established, 2%. Then the other dual mandate is to keep unemployment low, to keep employment high. But there is no unemployment rate mandate. Like it's not 4%, it's not 3.5%, it's not 5%, it's not 200,000 new jobs a month or 300,000 new jobs a month. It's just to keep full employment. So that gets to be a little bit fuzzy of exactly what that is. And as they do both of those things, they're supposed to keep the economy out of a recession. And in fact, um, you remember with Bernanke when the economy was in a deep recession, he went well beyond just lowering interest rates, and they started going into the market and buying back bonds and reducing long-term interest rates. And that quantitative easing uh, really helped the economy recover during the Great Recession, and Powell did the same thing during the pandemic. So they've got several tools at their disposal when there's a crisis, whether it's a financial crisis or an economic crisis. But really, their near-term focus is always 2% unemployment. I'm sorry, 2% inflation and full employment on the jobs environment.
So, a lot of predictions right now. So the Fed, I believe, is meeting in
Yes,
September, October, and December, right? They take November off, and they take this month off, correct? So I think they're
right.
meeting three more times between now and the end of the year, and the general perception is two cuts. So one would have to be in September, and I guess the other one would be in December. Are you in that camp? Where do you or August fall in terms of an interest rate prediction?
So, going back to those forecasts that we set at the beginning of the year, the economic growth, the lower interest rates, the good corporate earnings growth, uh, part of our interest rate forecast was that the Federal Reserve would cut rates two times. And I think during various times of this year, the street consensus has gone up to, maybe three or four cuts or down to zero or one cuts. But we've just held it at at two. And you know what, Michael? If they do just one, then maybe they do three in 2026, right? Is there really a big difference between, a cut in December and a cut in January? Probably not.
Probably
Um,
not. I agree with you. Well, look, they're at it, or they've run out of runway to do it four times unless they do it intermeeting, and that would be negative for the market, don't you think?
I think the market would interpret that as, uh-oh, something's really wrong that we don't completely have our arms around that the Fed is seeing.
And you
Whether
would
it's
think, and I'm sorry, go ahead.
whether it's subprime mortgages came out as a real surprise to the street back in 2007, 2008. And no one's anticipating, now the Fed is running these stress tests, right? they're making the banks get up and show their books once a year before they can pay a dividend or buy back stock. So I think that risk is reduced. But if the Fed were to make an intra meeting cut, then yeah, I think investors would be alarmed at that.
And you think would it be, I'm really putting you on the spot now. You think it would be a quarter of a point each time?
I think so. Um, so there's a real real yield on interest rates that the Fed is targeting for ultimately, and that's about 100 basis points above inflation. So, if they can, let's say they can wrestle, let's say inflation right now is 2.7%. If they can wrestle inflation down to 2% over the next couple of years, because it's not really falling fast anymore, it's kind of like a slower glide, especially with the tariffs. Um, but then within a couple of years, the Fed would probably want to have its federal funds rate at around 3% or three and a quarter, 3.5%. So that would be, four cuts from where we are now, four or five cuts from where we are now over these next couple of years. So
Okay.
I'm trying to like spread it out of where the Fed is trying to get. And if they deviate off that track, again, I think that's when you start to worry that maybe something's different or they're seeing something different that we don't see right now.
So I heard what you said before, and I agree with you about us being the world-class economy, the gold standard, the place where you go to raise capital from Wall Street. Do you worry that when Powell's term is over, whether he gets it completed or he just gets exhausted and resigns, that the next person in is just a yes person, and and the president wants lower rates or higher rates, he's going to ignore the data and just do what his boss wants him to do. I mean, to me, John, I worry less about the day-to-day minutia of the market and more so about the integrity of the Fed being tainted and losing its transparency and its independence.
Right. And I think, Michael, the kind of metric to watch for that isn't necessarily the Dow Jones Industrial Average, or might not even be outright the yield on the 10-year Treasury bond, although that's something good, but the U.S. dollar and what is happening to the U.S. dollar. Now, if you look at the dollar, it is higher than normal. It had been about 30% higher than normal, but now since Trump has come on, there's about a 10% ding to that. So it's still above historical norms, 20%, but no longer 30%. But if you were to see the dollar fall below its historical average, let's say fall 20 or 30% from where it is now, ooh, all of a sudden the U.S. isn't the top dog anymore, or there's some concern that it may not remain the top dog. The dollar falls like that, your 10-year interest yield is probably back up to 7 or 8%. That's going to send your economy, if it's growing about 2% now, that's going to push it, way lower, probably towards 0%, maybe below that. Um, and I don't think anybody in Washington wants to see that. And I do think that the candidates who President Trump has talked about so far, have a long history of working in finance, are well known on the street, are credible to a lot of long-term investors. So I do think that maybe they'd be under pressure a little bit at first, but at the end of the day, I think they would realize that their main job is to protect the status of the U.S. economy and financial system. And it wouldn't be Trump telling them that they're not doing it. It would be the global markets telling them, with a major stock sell-off, which the huge jump in interest rates and a plunge in the U.S. dollar.
I'm glad you said that. I feel a little better that you said that. And you reminded me, it seemed like years ago, but you reminded me when the when the tariff turmoil first started, and I don't know if it was organized or just everyone, all these countries started selling their dollars and the dollar basically collapsed. And what I read was, the Treasury Secretary went to Trump and over that weekend, and said, you got to tone it down. So they did get a taste of that, didn't they?
Right.
Kind of
Yes.
mid-April.
Yeah. Yeah. Um, I mean, that's in our research, Michael. Every month we've got a couple of reports coming out about the employment situation. That's so important. Now, these last 5 years, we've had a couple reports coming out every month about inflation because everybody wants to talk about that. And now we've added the dollar to our rotation as just kind of like a risk metric measure to stay on top of.
So, you know what? We have so much more to talk about. And really, the first half hour is basically done with, John. So let's take a break here and then we'll come back. And I also want to talk to you about the other headline last week where Trump fired the head of the Bureau of Labor Statistics because he didn't like the jobs number, and really the effect that might have on the psychology of the market and kind of where we stand with the world if the messenger gets shot if the president doesn't like the information. So a lot to talk about when we get back, and we'll take a quick break here and back with John Eade, president of Argus Research. All right, I'm Michael Hartzman back on the Lebenthal Report with John Eade, president of Argus Research, is doing double duty tonight. He is my guest host, and he is our guest featured speaker tonight. So, John, thank you again for doing double duty.
Glad to be here, Michael. It's really enjoying it.
Good, I'm happy to hear that. So am I. So, John, we were talking a little bit about the transparency of the Fed, and I agree with you. You know, other we are the world leader when it comes to capital markets and transparency and collecting data and the trust that companies have in our economy. So how worried are you when the messenger gets pushed, off the boat because the president, her boss, technically doesn't like the jobs report? So that's, the first part of the question. And the second part of the question is, does he have a point? Is the way we collect that data antiquated? And are we paying too much attention to that number to begin with?
Boy, Michael, that number has been, the number one number on Wall Street for decades now. That first Friday of the month. And of course it's not the unemployment rate. It's the number of jobs that are created that everybody is forecasting and trying to get right. And this time around, it wasn't necessarily so much the number of jobs, but the revisions to
Mm-hmm.
the prior months. So, it's almost like a derivative of the most important factors, the headline numbers, the number of jobs, and the unemployment rate. But I think it's very alarming that a longtime civil servant who has run this division and generated this content in the same way that her predecessors generated it. Um, and every first Friday of the month, the market waits and then acts on it like it believes it, right? Um, that data can suggest how fast the economy is going to grow. It can suggest whether the Federal Reserve is going to cut rates or not. So when and one of the nice parts about that data, Michael, is it comes out monthly and it's fresh, right? First Friday of the month, you've got fresh data from the prior month before any other fresh data comes out. So depending on, how they go, well, I guess they've put somebody already in place. I wouldn't think that in this first month they would change much about the surveys that they take and how they collect the data. But I would also think it's probably going to be a pretty high number with maybe some upward revisions for previous months too. And then you're
Yeah.
going to start to wonder, well, how accurate really is that?
Well, that's always well. See, so that is my question's always been. We're a country of over 300 million people, and we're talking the difference between 75,000 and 125,000. John, that's enough people to barely fill up Michigan's football stadium on a Saturday afternoon. I mean, does it really matter that much with a country the size of ours?
I don't think so, Michael. That outright number doesn't, but a trend might,
Okay,
right?
fair.
So a year and a half ago, you were averaging 150,000 payrolls a month. That's
Hmm.
nice. Maybe it was
Hmm.
200,000. And then, 9 months ago, it was 150,000. And then it was 100,000. And now when it gets to be 100,000, you're like, hopefully we can break this. And I think that's why President Trump is trying to push on Jerome Powell to, lighten up on the interest rates to kind of gas up the economy a little bit. Because, maybe 100,000 gets to be at a tipping point where, now business officials, executives read that number and they think, maybe the economy isn't as strong as I thought. Maybe I'll hold off on an investment or bringing somebody in. And then, when you go below that 100,000 down, to 10,000, 20,000, um, now you're even closer to negative numbers. So I think it's more of this trend than just one number.
Yeah,
Um,
and didn't that also happen a year ago? Didn't about a year ago? I know it was before the election that 800,000 jobs evaporated.
yes, yeah, they do revisions like that. That doesn't show up in the monthly number. That shows up in like the workforce
Mm-hmm.
adjustments that they do.
Mm-hmm.
So the labor participation rate shifts, things like that. But yeah, it's not an exact science. There are other data points related to employment, as you know,
Mm-hmm.
ADP, right? They cut all the paychecks for America, and they count those paychecks. And every month, and a couple days before the government reports payrolls, ADP tells you whether their clients are increasing the number of checks they're sending out to employees or decreasing that number of checks.
Mm-hmm.
And the ADP payrolls report, I think, was pretty good last week.
Mm-hmm.
It differed from the government's non-farm payroll report. And then there's a weekly statistic that maybe you look at, the weekly unemployment claims. That comes out every Thursday morning. So once a week, you can see, are more people, out of work and filing from claims? Are fewer people? Is it the same amount? And that number has been, at 25-year lows. Again, it gets back to where at low uh, unemployment rate, so there aren't that many people unemployed. But 220,000 has been the number for most of this year. A month ago, it jumped up to 250,000. And you know what? If that had jumped up to 300,000, I think you would expect a revision like we saw on Friday in the non-farm payrolls report. But Michael, it didn't. It didn't jump up. It came right back to that 220,000. So the unemployment claims are saying the employment environment is okay, even if the latest non-farm payrolls report gave a slightly different message.
For me, John, all that matters and it's all super important. And I appreciate what you said about the trends. But to me, I just hope that the rest of the world doesn't lose faith in the independent data that comes out, that it's not, no one's putting their thumb on the scale. And just to switch gears, I think I think August Research would agree, because back in 1934, when Harold Dorsey founded the company, you guys were the first to provide systematic independent research on US equities. So here we are 91 years later. You've been a great partner for us. You manage a lot of money for our clients. So talk about Harold Dorsey, what his goal was, and here we are 91 years later, and where you guys are today.
So he was worried in 1934, Michael, about the future of investment research and independent investment research. All of the banks were laying off their analysts. This is the Great Depression. So he came up with an idea of putting a staff of analysts together and then selling access to that staff to the banks on Wall Street that had been cutting back on analysts. And that was the business model. And one of the competitive advantages, one of the main competitive advantages, and this came up again even more recently during the global settlement, was the independence of our analysts. Our analysts are only working for our investor clients. We don't have an investment banking business like the big diversified banks do. So the corporations that are raising money and want to see buy ratings on their stocks aren't customers of ours.
Hmm.
If we think a stock merits a buy rating, it's because our analysts have gone through our 6 point fundamental system, which we've developed over time to come up with these buy, hold, and sell recommendations. So yeah, you're right. We've been doing that for 90 years. and the company is still owned by the Dorsey family.
Hmm.
Third generation of family ownership. The three granddaughters were a woman-owned business now.
Well, that's a obviously another feather in your cap and something that, Dom and I are big believers in. So that is great that the granddaughters have taken over and maintained that independence. And as I said, you guys have been a great partner of ours, and we appreciate that relationship. So getting back to the market, there's a lot to worry about. I think there's a lot to be somewhat optimistic about. Where do you or the Argus team, is the glass half full or is the glass half empty right now?
I think it's still half full, Michael. I think we're still in a bull market that began in October 2022. Going back to, I think, the 1980s, we've had, I don't know, maybe a dozen, 14 bull markets. On average, they last 5, 6 years. So we're about halfway into that. On average, the bull markets increased about 150, 160%. I think we're up about 80%. So I'm not going to say we're in the early innings, Michael, of a bull
Hmm.
market,
Hmm.
but I think we're still in a bull market, based on some of the data we're seeing. Obviously, stocks are up, that's good, but the economy's growing. Earnings are coming in, double-digit earnings growth here in the second quarter. The 10-year Treasury yield is down to 4.2%. It was 4.8% earlier this year. So we have lower interest rates as well. You look at the volatility index, Michael, the VIX volatility index. That's the fear index, and that jumped up toward 50 during Liberation Day and the announcement of the tariffs. But that's back below 20. 20 is historical average, and in the teens is consistent with. I'm not going to say a complacent environment, but it's consistent with a bull market. So. Um, it's not going to be straight up. We had 20% gains in 2023. We had 20% gains in 2024. You can't just, start in January and say, okay, we're going to put 20% gains down year after year after year. But I don't think this is going to be a negative year, unless something crazy happens, like, the firing of a Fed chief or something to really destroy the credibility of the U.S. economy and the U.S. financial system.
That almost left me speechless because it's been so crazy to begin with, right? And you could see those cracks where if Trump could fire the Fed chief, John, he would. I mean, it's clear that he would, and I think you're right. The only thing stopping him is Wall Street doesn't want him to, right?
Right.
And the tariffs almost seem to become white noise. Like August 1st, the drop dead date comes and goes. So and nothing really happened. We dropped a bomb on Iran. And the market's like, okay, so what could, again, you don't have a crystal ball. We don't know what that black swan is, but we've taken so many body blows now that I kind of agree with you that the glass has to be half full, because what can possibly happen that we haven't absorbed yet that would cause the market to completely lose its underpinnings.
So you try to look around for bubbles, Michael, right?
Hmm.
There was a dot-com bubble, and that led to a bear market in 2000.
Hmm.
There was a real estate bubble in 2006, 2007 that led to the financial crisis. There's been oil price bubbles, right? Oil got up to $160 a barrel. Um, where are the bubbles right now? Oil's at $65 a barrel. The tech sector is big, right? It's about 35% of the market, but um, tech companies are delivering great earnings here in
Mm-hmm.
this second quarter earnings
Mm-hmm.
period. I think there's a real solid foundation of earnings and profitability in tech that just wasn't there back during the dot-com crisis. And my guess is doesn't really mean much, but I think S&P is probably going to like break up all its sectors again, right? And maybe split technology into two so it isn't so big. Maybe software and semiconductors and do something like that. But I mean that's not really the point. The point is, what bubble might pop. And there was a threat to the tech sector back earlier in the year, right? When the Chinese AI company came out with something that looked cheaper and looked better and that's moved to the background. That's not the threat it once was feared to be, but that could happen, and you know, not everybody is really out looking for that right now.
Right. And you're right. While the Mag 7, the Magnificent Seven is not necessarily a headline, at the moment, those tech companies have really done really phenomenally well from the bottom from mid-April. They've really had a great rebound. So I agree with you. It's certainly not a bubble, but do you worry that those six or seven companies or five companies are kind of pulling along the other 495 in the S&P 500, John?
You like to see breadth in the market, Michael,
Mm-hmm.
and we have a chart we're going to show next tomorrow actually on a webinar we're doing for all of our clients about sector breadth. And you know what? You're not going to believe it, but the number one sector this year is the utility sector,
Yep.
right?
Mm-hmm.
That's not a hot tech play necessarily, although those data centers use a lot of utilities. But financials are strong, communication services are strong. Tech is the fourth best performing sector this year. So
Mm-hmm.
I think we're seeing some market breadth. It's not just the Mag 7 the way that it might have been, in late 2020 or 2023 and 2024.
Do you think consumer discretionary has been lagging because of the tariffs and people are just kind of holding off on things they don't necessarily need if they don't want to absorb a 10 or 15% increase that's kind of artificial?
Well, I think yeah, that's a concern. I think the bigger issue is that Tesla probably makes up 40% of the consumer discretionary sector, and Amazon makes up the other 40%. So, if Tesla is way down this year, as it is, that's going to hang over, the headline numbers of the sector. There are some of the restaurants are doing very well. The services
Mm-hmm.
spending has been good. Some of the retailers are turning around. Abercrombie and Fitch, Gap.
Mm-hmm.
I think that and Michael, I try not to invest just on sectors. They're kind of arbitrary in a way. We like to look at themes like dividend growth and what that says about a company, or a company where, management sets guidance and beats that guidance quarter after quarter. So you get real confidence in the management team. Um, that's we look. I look more at those kinds of factors for portfolios than the healthcare sector or the financial sector.
So you and I didn't speak before the podcast. Um, so if this is a little out of your wheelhouse or something you don't want to comment about, that's great. But if you can, talk to me a little bit about Bitcoin. It appears to me that it's here to stay. It appears to me that this administration is all in. It appears to me that while a bubble seemed to be a forming, and one never did. So does Bitcoin have firmer legs to stand on now than it did a few years ago? It's certainly here to stay, in my opinion. But if you have an opinion about it, what do you think is next for the not even Bitcoin? I should be more broad cryptocurrency.
So what was next for crypto before now, or maybe this was two developments ago, was regulation
Mm-hmm.
and ETF. And when the SEC finally signed off on it, and this is the SEC that, makes companies jump through hoops to prove that they've got, real businesses and real balance sheets and everything. When the SEC signed off on a Bitcoin ETF, and you could trade a security in an exchange instead of going to a dark part of the market and buying, some coin with a kind of weird code key. Um, now it's become it's moving into the mainstream. Okay. Um, I think the Bitcoin right now, we think of it as an alternative asset,
Mm-hmm.
in the same way that, gold is an alternative asset, or, maybe commodities or oil. And I think the market cap of crypto now is maybe 5 to 6 trillion.
Mm-hmm.
And the gold, um, gold's had a great year too, by the way. Great
Mm-hmm.
couple of
I
years.
know.
Gold is about 12 trillion. So, a lot of our clients like to have gold in their portfolios as an offset to inflation, as
Mm-hmm.
an offset to, kind of global geopolitical developments. So maybe they'll put in 3 to 5% um, of their portfolio into gold. Right now, Bitcoin isn't as big or as dominant as gold, but I do think it's on a path toward a future as a legitimate alternative asset
Mm-hmm.
for investors. And we've started to add it into some of our more aggressive ETF model portfolios. Not a lot, right? Like 2%, 1%, something like that, but it's starting to make an appearance for us. And we've just launched Coinbase. Coinbase was added to the S&P 500. Now, stocks come and go in the S&P 500. Bitcoin blows up, they'll drop it from the S&P 500, but it's there right now.
Look, it's definitely gained some legitimacy and some traction. And one of the Bitcoin ETFs that started trading in January of 2024 has $86 billion in it
Hmm.
right now. In a year and a half, they've raised $86 billion. So, you know, yeah, it's definitely become more mainstream. Um, so we have literally about 2.5, 3 minutes to go, John. If what do you think? What sectors or sector do you like for the last third of the year that you think can be resilient with all the headwinds we might face?
So we've done a couple things, Michael, this year with webinars. We've tried to drill into sectors and pull out pieces of sectors. So I'll give you an
Hmm.
example. Banks or financial services, right? Financial services includes banks, it includes insurers, but it now also includes more innovative companies like payment processors like MasterCard and Visa. It includes innovators in passive investing,
Hmm.
like BlackRock or the data companies that put together these indexes, MSCI,
Hmm.
SP, Moody's. So and although they're in financial services, they really have like a tech and data and number crunching background to them. So I think that's a way to tap into the growth opportunity in a network or in technology, without buying Nvidia
Hmm.
or Alphabet.
Hmm.
So fintech is something that we like. And then also, communication services. Again, it's kind of an arbitrary sector. It includes Google and Meta. That's nice. And it also includes Verizon and AT&T.
Hmm.
Why? Who knows? But in between there, you've got companies that put apps together that come in and disrupt businesses like DoorDash in restaurants, like Airbnb in lodging, like Uber in mobility. Um, and so you're in communication services, but you're not in AT&T and Verizon. You're getting kind of closer to these growth network areas, but you're not buying Meta or Alphabet necessarily. So
Hmm.
just on the outside of that Mag 7, I think there's some opportunities where maybe you're a little bit away from the bubble risk of the Mag 7 too.
John, we are out of time, unfortunately. I didn't even get a chance to ask you about the international markets and some couple other topics, so we'll definitely have to have you back
Okay.
if you agree to it. But thank you again for doing double duty tonight, and thank you for the great partnership that Lebenthal has with Argus Research.
Well, thank you, Michael. I enjoyed it. We appreciate your support and the relationship.
Same here. So have a good night, everybody, and Dom and I will be back next week with a new edition of the Lebenthal